And welcome everybody to the latest in the IMAP series of webinars. Today's webinar really is focused on the topic of considerable interest as interest rates plumb new levels, and the general discussion in Australia and globally is whether low interest rates and a superfluity of capital is a sign of opportunity or a sign of struggles in investment markets to come. The people who are on the receiving end of that low interest rate environment are really the investors. And today's session is really about interest rate opportunities outside the more conventional mainstream TDs, banks, cash accounts, and away from dividend-based equity strategies. In a moment, I'll hand over to Michael Watson from LaTrobe Financial to talk about their view of interest rates and income opportunities for retail investors. But just before I hand over to Michael, let me just talk a little about a couple of upcoming events at IMAP. For those of you in Sydney, next week we'll be holding the first of our FinTech cocktail events for 2019. The purpose of these is really to try and show a little about how technology is transforming managed account operations and the intersection between new and emerging technologies. And I'll talk a little more about the participants in that in a moment. Then I'll talk about the Portfolio Management Conference on the 6th of August. That's the third year we've run that, and we're pretty excited about that. And then for those of you who are involved in the operation of your license, we run Responsible Manager Masterclasses each year, and we'll be running another in Sydney on the 17th of September. So just to touch a little on our FinTech evening. This is really an opportunity to show emerging technology. So with the support of Refinitiv, who will be known to many of you as the Thomson Reuters data business, another year, another name change, we're bringing really together two FinTechs and Refinitiv themselves to talk about the way in which artificial intelligence is being applied in advice. Investum were one of the finalists in the IMAP Innovation Awards this year, and we're delighted to have an opportunity to allow Regis Scapoyard to talk about what Investum does and how it allows portfolio management. And then Advice Intelligence, Jackie Henderson is talking about Advice Intelligence and their goals-based investing approach to advice. And then Refinitiv's specialist in AI will be talking about the leveraging of data and the opportunities that AI and big data offer for advice businesses. Moving on to the Portfolio Management Conference. This year, for the third year in a row, we're running our Portfolio Management Conference with a focus on managed accounts and the investment processes that really are required when the outcome is individual portfolios rather than a pooled structure. This year we've split the Portfolio Management Conference into two parts. In Sydney in August on the 6th, we're running strategic perspectives. So this is portfolio management, portfolio construction, manager selection, risk management topics, the higher level strategic issues that have to do with portfolio management for managed accounts. And we're lucky enough to have a number of our Managed Account Award winners talking at that about how managed account services that they offer are applied in their portfolios. You'll see on the screen a number of the topics that we'll be presenting. So combining fund managers, asset allocation, practice-based investment management. So this is running portfolios that are intended to be used to support an advice practice, values-based investing, building better portfolios, risk management, and the tools that are necessary to manage risk in portfolios, and then an session on implementation. I'm looking forward to that. In October in Melbourne, we'll be then drilling down to the next level of detail. This is sector-specific investment management, stock picking in Aussie equities, international equities, themes in international equities, factor-based investing, and direct access to fixed interest. So now what I'd like to do is hand over to Michael Watson from LaTrobe to talk to us about credit-based investing. Michael, over to you.
Thank you, Toby, and good morning all. It's really exciting to present to you all today, everyone who's dialed in for this webinar. This is our first presentation to an IMAP audience, so really keen and excited to do so. So special thanks to Toby and of course to Jane and Jenny behind the scenes for making this work. In this presentation today, I'll be having a high-level look at property credit. Property credit is a particular asset class right now, as it continues to demonstrate resilience across varying economic and political cycles. It's forming the bedrock of many investor portfolios right now and increasingly important. The modern dynamic for longer and the hunt for yield and these sorts of things you hear trot out, of course, looks set to continue, placing even more importance in resilient, higher yielding asset classes for investors. Now, along the way, we do have a question and answer screen up and running, as you'll have seen. So please, if you've got any questions, feel free to reach out and we'll see if we can address them there and then if time permits. It's a nice, simple agenda today. I'll introduce LaTrobe Financial. Many of you know who we are, and I believe that I've had a look through the attendee list. A lot of you of us, which is fantastic. But I'll give a bit of an introduction on LaTrobe Financial so you can see what we're about, what we're up to, and some changes to the business in recent times. Number two, I'll drill into the resilience of our asset class, why that's being so resilient with the various factors that have been affecting it of late. And at the end, I'll dovetail that into a discussion about the LaTrobe Australian Credit Fund, our products, so you can see what our view on the asset class is and the best way to extract value for investors. So as to turn to the first agenda point, just a quick introduction of LaTrobe Financial. I guess the first thing to note with LaTrobe Financial is that we've had a sole focus on property credit asset class for nearly 70 years. We started operations back in 1952, so we had an unbroken commitment to property credit ever since. These days, we're around $9 billion in assets under management, and that $9 billion is all deployed into diversified portfolios of mortgage secured loans. We're talking very granular assets, home loans, small commercial loans, these kinds of things, all low loan to valuation ratios, and all fully credit assessed by our trained credit analysts. We've now got 350 staff at LaTrobe Financial across Melbourne, Sydney, Shanghai, and Hong Kong, and indeed representatives all around Australia. We've managed cumulative institutional mandates of over $17 billion, all without loss to our institutional mandate partners, or indeed any investor in any of our pooled retail offerings, which I'll speak to a little later on. In terms of our sources of funding, I'll go through that in a moment. Importantly, though, in 2017, 80% of LaTrobe Financial was acquired by the Blackstone Group, who you may be familiar with as the world's largest alternative asset manager. Blackstone also share our view on the enduring resilience of property credit, a stable asset class that generates low volatility yield across every business cycle. But it does bring us to our funding sources, which you can see on screen right now. Diversification is, of course, important in any investment strategy. This is also true for the funding strategy. And on screen now is our treasury function, essentially. What you're seeing, number one, our institutional investment partners, our mandates. So we receive anywhere from $100 million up to about $1 billion right now from local banks, regional banks, and overseas banks. And as you can see, we've got 8 on hand, totaling about $3.6 billion presently. Again, when a bank looks at LaTrobe Financial, they, like us, are very active in the asset classes as asset class specialists. So we take their confidence in us as a huge seal of approval, and our investors see that and like that as well. Working hand in hand with our institutional warehouses is our debt capital market issuances. You can see that as number 3 there. We're an active RMBS issuer with about $2.7 billion of active RMBS notes in the marketplace. Purchases of those notes include local fund managers, for example, super funds, international pension funds, and the like. In fact, if you are invested into some Australian fund managers that are fixed income managers, there's actually quite a good chance you'll have access or you'll have some exposure to a LaTrobe financial note through those fund managers. The third leg, interestingly couched at number 2, is our award-winning $3.6 billion LaTrobe Australian Credit Fund. Now, I'll talk to that a little later on in the presentation as our products, but what that is, that really is our view, as I mentioned, on the best way to extract the best attributes of the asset class for retail investors to achieve resilient, capital stable returns across all economic cycles. With that introduction of LaTrobe Financial, I'll now turn to our asset class, property credit, and as I've mentioned, it's been continuing to perform with resilience over a long period of time. There's been changes to the supply dynamic of late. There's been regulator-driven macro-prudential reform. We've experienced the Hayne Royal Commission. There's been ups and downs in property markets locally and around the country as well, changes in population, and of course, fluctuations in cost. So there's been quite a lot going on, but the asset class has managed to continue with resilience across all of these cycles. Having a look at it from the top down, I'm sure you'll have all had a home loan at some point, maybe a loan on an investment property, potentially a loan within a self-managed super fund. These assets combined create an extraordinarily broad and deep asset class, circa $1.8 trillion in residential home loans alone, a further $660 billion in commercial mortgages, so combined making an asset class of over $2.5 trillion. The strength and resilience of Australian banks can largely be credited to the resilience of property credit. Its remarkable stability presents excellent characteristics for investors too. I'll turn quickly to the supply dynamics around property credit. Now, I mentioned earlier that Blackstone see a tilt back towards non-bank lenders globally, and that's sort of what you're seeing on screen now in the Australian sense. If you were to go back in time along this chart, from back prior to 2002, you'd see banks having about 80–85% market share and non-banks 15–20%. That tends to be the dynamic. What we saw in the mid to late 2000s though, we saw a credit crunch with non-bank lenders having difficulty raising capital, and also in that period of time through the GFC there, banks being really nervous about where the best place to deploy their capital was. What did they decide? They went heavy on residential mortgages. And you can see that uptick there through the 2007 to 2009. Through this period, banks here in Australia were writing 97% of all new home loans being written. And in doing so, you can see the increase in market share they took quite swiftly, well over 95% in that time as well. Now, it would be unrealistic to assume we'll see a swift mean reversion here, but remembering the size of the asset class, you can see that how a small change in market share dynamic leads to a big shift in opportunity for a non-bank lender, for investment managers like a LaTrobe Financial. So we see the change back towards non-banks playing out in the short to medium term. In terms of the annual changes in credit growth, that alone makes for an interesting discussion in its own right, particularly as the growth in housing credit has been trending downwards year on year, as you can see on the chart on the left there, for quite some time now. Goes against market commentary you may have heard as a sector out of control. So on the left-hand side, what you can see is owner-occupied credit growing at around 5% year on year, demonstrating resilience, remembering at a $1.8 trillion market growing at 5% per year, very strong. Likewise, despite all the hyperbole, investor loans, as indicated by the red line, has still not gone negative at any point in time, since 2005, as you can see there, where this chart starts. And the leading indicators to both demonstrate that we'll see these picking up into the near future. Pleasingly, throughout all of this growth, the growth has not been at the expense of quality. And as the chart on the right-hand side shows, you can see owner-occupied credit above 90% falling significantly. You can see investor loans above 90% loan-to-valuation ratio practically at zero. You can see interest-only loans and interest-only loan approvals falling dramatically over the last few years. And that points towards controlled growth, and it points towards constraint and restraint from the sector, ensuring that the underlying assets in this enormous asset class are quality assets. I mentioned macro-prudential reform earlier. What this is simply focused regulatory change. And in this case, over the last few years, had the clear intention of reducing investor-driven overheating of the residential housing markets in Melbourne and Sydney, and has been very successful in doing so. It's not new, macro-prudential reform. Indeed, reform has been around for a long time. What's been interesting has been the pace of the change and the volume of changes within that time frame. It's also, if I may say, one of the few times we've seen a big regulatory change ahead of an issue, as opposed to as a reaction to an event. So it's also quite pleasing there. But over the past 5 years, there's been changes, including the caps on investment lending, as we saw on the previous slide, serviceability testing enhancements, increased capital requirements by banks and non-banks, interest-only loan limits to ensure that there was fewer interest-only loans being written, and consolidation of rules across banks and non-bank lenders as well, ensuring that there is consistency there. Now, we saw the effect of macro-prudential reform on the previous slide, particularly with reference to interest-only loans. They worked really well, or it's worked really well in taking the hotspots out of Sydney and Melbourne property markets, and also to deliver that structurally resilient asset class. The Royal Commission was the biggest show in town last year, no doubt. I'm sure you were all well and truly across that. But where does it leave us as lenders? The key outcomes, I should say, to the Royal Commission are on screen presently. They broadly relate to how a lender should test a borrower's capacity to pay and how mortgage brokers will be remunerated. Now, focusing on the former, focusing on testing a borrower's capacity to pay, the discussion was largely around, should we have manual assessment or should we have automated assessment of a borrower's capacity to pay? Now, as a non-bank like LaTrobe Financial and our competitors, our point of difference is largely our ability to have multiple trained credit analysts looking at every single application that comes across our desk. So from our perspective, a move to manual underwriting more so across the sector is fine. We're very comfortable with that. However, it has been a big point of interest for banks to consider as they've gone from, their loan factories when all said and done. So for them having to have increased assessment, for them having to take more time on an application, has caused them to be very inwardly looking for this last year or so, as they've changed processes, they've changed structures, and no doubt many of you will have come across this either personally or anecdotally among your peers with banks having been more difficult recently to achieve finance from. How that plays out, we'll wait and see. There's some interesting cases that we could talk through right now, but I won't for the sake of time. There's a lot going on there, and I'm not entirely sure where that will finish up. And likewise for broker remuneration. Mortgage brokers these days are writing 60% of all home loans in the market, remembering, of course, that it is an enormous asset class with huge volumes, something like $400 million of new residential loans each and every year. So we see any changes to broking as likely to be around the edges, more so than any wholesale changes. The broking industry did a tremendous job in lobbying shortly after the Royal Commission handed down its outcomes. So where that ends up, we'll wait and see. But again, we suspect it will be more around the edges than anything. Another important consideration when talking about property credit is property itself. Property markets, as you know, go up and they go down and everywhere in between. You'll have observed this over the years yourself, no doubt. But in the last few years, in that lead up to 2017, when people were raising concerns about property, it was typically about Melbourne and Sydney. The other capital cities, as you can see on screen right now, mixed results. Australia hasn't got one unified market. There's markets within cities, there's markets regional, which are different to the capital cities as well. In the lead up to 2017, any observer could see that property was expensive in Melbourne and Sydney, and any observer could see that the growth that we were experiencing was unsustainable. The big question was, what would a cooling off in Melbourne and Sydney look like? Would it be some kind of catastrophic overnight drop, like say in Ireland, where property prices fell 43% and there was high arrears and high defaults and high unemployment? Or would it be an orderly correction without some broader economic shock, with low unemployment, with economic growth, without shifts in arrears patterns from the borrowers themselves? What we're seeing on screen right now, undoubtedly property is being affected by the volume of credit in the market, by the increasing costs in funding, by the Macro-Prudential Reform, the Royal Commission, etc. But what we are seeing is a textbook example of an orderly unwinding across Melbourne and Sydney. Importantly as well, the highest falls in property prices have been in the most expensive locations. That's very important, and it means that the more affordable property has remained resilient overall. Also, as you can see there on the monthly falls in Melbourne and Sydney, these figures being the end of June, you can see they've actually the falls have stopped, and we're looking to see some positivity there as well. There's some leading indicators indicating a return, a revitalisation of the market. And likewise, this slide right now demonstrates that as well. You can see the cycles of property across Melbourne on the left and Sydney in the right. You can see that corner having turned, and that the unwinding, whilst it's been relatively speedy from 2017 through 2019, has not been cataclysmic to either market. Undoubtedly, though, population growth is worthy of consideration in any discussion about property and property credit. And you can see again on the left-hand chart there, the strength of the growth through Melbourne and Sydney, or New South Wales and Victoria, being the red line and the blue line in the last few years, with Melbourne and Sydney both adding between 130 and 140 new residents each year through natural growth and net migration. Importantly, though, when you're talking about population, talking about the drivers of property, no one sector had been driving property and or continues to do so. Investors absolutely were behind it, but so were first homeowners, so were second homeowners, so were international buyers, so were downsizers, all across the economy, because we had reasonable economic growth, because we had low unemployment, because we had low interest rates, and we continue to have low interest rates, of course. There's been a clean market across the whole sector, and as prices in residential housing and property generally has fallen, simply the marginal buyer has re-entered the market. Everywhere live somewhere, everyone's got to live somewhere. Hence the discussion around population. So we're seeing in Melbourne and Sydney a requirement for around 40,000 new houses each and every year, and particularly that's been growing in the last few years. But as the graph on the right hand of the screen right now demonstrates, it hasn't been met with an increase in the commensurate volume of new home sales. Now that creates, of course, a demand-supply mismatch, and it's been part of the reason why property has been so robust as well, because we simply haven't been building enough stock. Now, apartments are one discussion, but that's of course only again around the edges of this entirely huge asset class. But of course, in terms of leading indicators, what a difference the election has made. And you can see in the bottom right-hand corner there, the spike in new home sales post the re-election of the Morrison government. And again, leading indicators pointing towards a resilience of property credit. The final point I'll talk to about what's been happening in property credit has been the changes in funding costs over the last few years. Quite a lot of moving pieces for lenders to consider, but of course the cost of funds is a very important factor for them. And for us, indeed, for any lender of credit in Australia. The elevation of cost and the volatility of funding has quite noted in the last few years. Again, if you had gone back in time, you see strong correlation between the official cash rate, which is the red line on the screen there, and the BBSW rate. However, in 2017, particularly late in 2017, that correlation separated, and we saw heightened cost and heightened volatility in official cash rates. Now, you'll also remember through that period that some home loan lenders were increasing their borrowing costs outside of any step by the Reserve Bank. Why were they? This had a lot to do with it right here. Now, you can see that it's normalised now, and you can see that the official cash rates and the BBSW rate are in sync, which is great in terms of funding costs and the capacity to plan. However, what was that variation? What was that all about? It largely came down to international policy. Now, locally, of course, there was a bank levy introduced, and that did affect the cost of funding, particularly for the BBSW. But internationally, it largely came down to Mr. Trump over there in the White House. You'll note that he came into power late in 2017, and in doing so, what was he introducing? America First policies, looking to repatriate funds back to the US. That's what we saw. We saw a huge repatriation of capital, drawing liquidity out of the market. And of course, when you pull liquidity out of the market, the cost of that liquidity increases. So that's really what that's been about. Now, as I mentioned, it has normalized now, but it's been really important for lenders, for banks to keep an eye on. And of course, where it tracks into the future, we'll have to wait and see. I hope through that part of the presentation, I have demonstrated or illustrated an enormous asset class that has a very dynamic set of factors at play at the moment, but throughout that has demonstrated a wonderful resilience. And I keep coming back to that word resilience about this asset class. With that in mind, I'll now introduce you to how we harness the best attributes of property credit for investors via the LaTrobe Australian Credit Fund. Our products are on screen right now, and it's important to note that LaTrobe Financial is not a bank, and therefore our products need to be considered differently to, say, bank term deposits, because we're not subject to the government's bank guarantee. But we do have the credit fund, which you see before you, which has about $3.6 billion of assets under management, built around 5 key account strategies. As a very brief summary, the classic 48-hour account is a fantastic option. Money in a short-term home, or indeed simply requires a shorter-term liquidity window there. At 2.6% per annum variable rate with income paid monthly, it's a very popular product indeed. Recently introduced our 90-day notice account as well. So our 90-day notice account provides flexibility with market-leading yield and 90-day liquidity. Presently 3.1%. Again, variable. You can invest as long as you like. Funds are simply returned to the investor, generally 90 days after receiving written notice from the investor. Of the products on screen right now, our flagship is very much our 12-month term account. That offers strong variable rate of return, presently 5.2% per annum, and again with monthly income paid throughout. If an investor comes to us through a financial planner, because the financial planner has done the work of finding the client, introducing them to us, all the AML and etc., we reduce our management fee by 50 basis points, and we pass that back on to the investor as enhanced return. So what they're seeing there is therefore a combined return of 5.7% per annum, again with monthly income payments paid throughout. The 12-month term account has been rated by Zenith and Lonsec as recommended, and SQM research of 4 1/4 stars. It's also won Money Magazine's award for the best mortgage fund in Australia for the last 10 consecutive years. So it's you can see how well regarded it is in that sense. We focus on diversification, so we have exposure to lots and lots of smaller loans spread right around Australia with conservative loan to valuation ratios. And by that I mean the average loan in that portfolio is around $540,000. The average loan to valuation ratio is 62.4% presently, against a maximum LVR of only 75%. So we always maintain capital, skin in the game for our borrowers there, ensuring that our investors have capital stability. That product, I'll talk a little bit more to that product in a moment as well. Our high yield credit account. Now, I did mention that we do RMBS issuances from time to time. Our high yield credit account is for more sophisticated investors, being a minimum investment of $250,000 and a 4-year investment term. What you're investing into there is mezzanine RMBS notes and bank warehouse notes with structural enhancements to protect investor capital. And again, I can talk to you offline about that if you have an interest in that particular product. And the final product across on the right-hand side there is our Select Investment Account. That's Australia's largest and only independently rated peer-to-peer investment account. We've offered investments into peer-to-peer loans now for over 25 years. And we have Australia's largest portfolio, as I mentioned there, of peer-to-peer investments opportunities, where your investors can select the risk return profile, the duration profile, the geographic profile that they like of the assets, and we deliver it in a really innovative way. So that's, if you like, a quick overview of the 5 products that we have through our retail credit fund. A little bit of focus now just on the 12-month term account and the resilience and the stability that is demonstrated now since inception back in October 2002. The orange line that runs through the middle of the screen is our annualized rate of return to investors. And you can see just how stable that has been. We're harnessing the best attributes of asset selection, of structure and management to deliver on an objective, being that sleep easy investment for your investors. Again, of course, positioning us with inside portfolios, we are aware that we need to have a solid margin above term deposits, of course, to have a reason for existence in any portfolio. And you can see now the margin that we've maintained across cycles now above term deposits. Again, the 12-month term account being the orange line at the top there, and various classes of term deposits thereunder. We've always managed to maintain that return above term deposits, which makes us worthwhile as an alternative within investor portfolios. Now, cumulatively, again, if you look at stability plus stability, you get what you see on screen right now: sustained performance over a long period of time, and the magic of compound interest. Had your clients had reinvested their income of their initial investment within the 12-month term account, again, that orange line on screen right now, actual returns and the actual growth they would have seen in their account with us since the fund began back in 2002. And you can see, of course, there's been quite a number of economic cycles through that time, business cycles, political cycles, and the product, the 12-month term account, has simply managed to go along with stability, with consistency, and all these sorts of things which are so important to it. Now, the fund, and particularly the 12-month term account, is typically considered a fixed income option for investors, and it's used in the creation of diversified income strategies. And at 5.2% with a 0.5% rebated fee, making 5.7%, you can see why it is increasingly popular. Some consider it an alternative group, or as an alternative, or perhaps they'll group it with property. However, as the last few slides have demonstrated, no matter how it is categorised, the 12-month term account has had zero capital fluctuation and remarkably low volatility in its return. And that's an excellent starting point, we feel, for any product. And to that end, it's simply a high-yielding income product that prioritises return of capital. That's what it comes down to. Importantly, the 12-month term account is also available on over 250 approved product lists around the country. That's on the investment menu of a range of platforms, including Macquarie, AMP, MyNorth, CFS's First Wrap, Ultimate Wrap, Hub24, OneView, Power Wrap, Mason Stevens, Netwealth, IOOF Pursuit, and a few others as well. Platform investors enjoy flexibility of a monthly liquidity model, and that 30-day liquidity model allows for active liquidity management. And that means it can undertake monthly portfolio rebalancing, which is so important, of course, particularly when you're discussing this with a managed accounts audience. Under the platform liquidity model, we maintain a minimum cash holding to meet monthly redemptions per platform with no set maximum cash holdings. That way we can simply adjust our liquidity holdings regularly to meet requirements there. Importantly, since the fund began back in 2002, we've never had to gate liquidity in any way, be it for direct investors or be it for platform investors, So we've got a really, really strong track record in this environment. And of course, we're seeing investment through our platform partners via managed accounts that are comfortable with a monthly rebalance. So we encourage you to consider us as an alternative in this space. I'm just going to refer to a question now. And indeed, if anyone has got other questions they'd like to raise as well, but a question coming out. So what are the average loan characteristics, size, term, etc. within the 12-month term account? Thank you very much for raising that question. As I mentioned, we focus on having a large basket of smaller loans. So the average size of the loans in our 12-month term account is around $540,000. Flexes up and down, of course, as you can appreciate. The average loan to valuation ratio is 62% with a maximum of 75. In terms of duration, we've got a good mixture of durations within our portfolio. So we have a ballast of longer term loans and also a strong cycle of shorter term liquidity. We have over a quarter of our loans due to mature within 12 months, and that goes up to more like half, so 50% of our loans within sort of 2.5 years. And with that profile, we've got such a strong cash amount coming into the 12-month term account each and every month through refinanced and concluding loans all in all. We're very, very comfortable with that as our ability to perform. Another question, will I get copies of the slides? Absolutely, you will. And that will be presented by IMAP after the presentation. Thank you. And the final question that I've got here is, are these options available through Macquarie Wrap? Our 12-month, that's an interesting discussion. We have our 12-month term account as the product that we have taken to market through platforms. That's on the 12. So the 12-month term account is on Macquarie Wrap, and those other platforms I just mentioned. So IWF, AMP, CFS, NetWealth Hub, and the like. We don't want a lot more, our other products, our shorter-term liquidity products on the platform, because we're a lender, we're investing into term assets, so we need to have asset liability matching. And that product, called the 12-month term account with the monthly liquidity option, is working quite nicely there. Question about defaults in the portfolio. Getting some good questions. Thank you very much out there. And how we manage that. Of course, we absolutely experience defaults in our portfolio. You can't have loans without having defaulting loans, of course. What we see 90% of our observations of fall between 2.5% of our portfolio and 4% of our portfolio. And we are extremely comfortable with that. Over the last little while, you can probably appreciate that arrears have been a touch lower than they have been historically, being in that low interest rate environment. And also, as banks have tightened up, we've managed to, we've been attracting a more bank-style customer into the portfolios as well. But we are seeing a tight and controlled level of arrears within our portfolio as well. Arrears don't mean losses, of course. We do provision for losses through our investor reserve. And that means we typically hold between 50 and 80 basis points of FUM in reserve to meet annualized losses, which have been historically between 12 basis points and about 16 basis points. So very low controlled losses, which have been well and truly over provisioned for through the investor reserve. And I think that's covered all the questions to date. Do I go back onto the screen now? This on screen right now, you can see our arrears performance over time, as I mentioned. It's cyclical in nature. It tends to be a touch higher in the first half of each year, with this year being no different. But what you see on screen right now is our arrears from 30 days up to mortgagee in possession. Pleasingly as well, the MIP, the mortgagee in possession, has been on a downward decline of late, which is great to see. It's good from a provisioning sense as well. Less mortgagee in possession is where the losses have to originate from, of course. So that's pleasing. On the bottom of the screen as well, you can see those losses since inception, somewhere between 12 and 16 basis points there over time. And as I mentioned, we typically hold between 50 and 80 basis points in reserve. That reserve is presently at around 63, 64 basis points. I mentioned peer-to-peer. Our peer-to-peer is delivered in an interesting way. We have a shopping list, what we call our investment shopping list on our website. We have between 60 and 80 individual opportunities at any one point in time. And you can see how you can select loans that suit your location preferences, your duration profiles, your return requirements as well. The minimum investment in this product is only $1,000. So what we see investors do is select a group typically of loans that suit their requirements and build their own, if you like, their own portfolio, their own pool of loans, and they'll work with our investor team to do so. So our investment shopping list is on our website. It's quite easy to navigate, and the individual investments themselves are made through supplementary PDS or an SPDS, which simply they have to execute and return to us. Then we place the investment accordingly. Just finally, to our high yield credit account. I mentioned this is an investment into RMBS notes and bank warehouse paper as well. The underlying assets, of course, are residential mortgages or residential loans, and you can see the split across the bottom of the chart there, diversified across Australia with the population, Vic, New South Wales and Queensland being the overwhelming home for those assets. Overwhelmingly as well, metropolitan. We do have non-metro. Typically, when we're saying non-metro, we mean regional centres, your Geelongs, Bendigos, Ballarats, those sorts of places. We do have rural as a product option, but that's not here. And as well, roughly 46% split to owner-occupied and investment. So we've got a good balance there as well. Now, again, this is RMBS notes and with the underlying assets being diversified portfolio of first mortgages. It's a 4-year initial investment and rolling 2-year terms thereafter. Now, I believe there's another question there as well. Are the peer-to-peer products rated? They are. They're rated by SQM Research, where they are given 4 stars, so 4 out of 5 possible stars through SQM. In terms of our size, I mentioned before we have 350 staff. On screen right now, I'm on there somewhere as well as head of distribution, but you can see our BDMs and our senior account managers nationally. We have all of the major cities covered there, and we have a team of 4. It's worth noting for our advisor partners out there, we have a team of 4 in a dedicated financial advisor support desk. So you can see Sean, Kim, Rachel and Kelly there, who are taking that role and provide really good customer service to our financial advisors. So in conclusion, I'd like to thank you all for your time and your attendance to this webinar. I hope the presentation has been informative, and I do hope that I've demonstrated that the property credit fundamentals have remained resilient in the face of quite significant structural and systemic upheaval across a whole range of factors, and particularly strongly within the last few years. The underlying assets themselves are stable and robust, offering opportunities for managers to extract value for investors through stable, consistent income products. And finally, I hope that I've demonstrated that LaTrobe Financial's track record of nearly 70 years experience within this asset class provides market-leading products. And those products, as you can see on screen right now, available on over 250 APLs. We have over 1,000 individual advice practices that are supporting the fund in one way or another. And we're on the investment menu of all the most of the major platforms there as well. The product, of course, has been researched and regarded, as you can see on screen right now. But that is probably it for me, and I'd like to hand back over now to Toby. Thank you, Toby.
Look, thank you very much, Michael. That was interesting. Now we've had a question in from Don Carlos, who put your hand up. So we're going to try something new, Don, today, which is to allow you to talk. So if you've it looks like you're on mute. So if you want to unmute your phone, you can ask your question verbatim, Don. No, right. Okay. Well, I did. Well, you do unmute. You're able to talk. But I have a question, Michael, which really has to do with the sort of managed account issue, or at least portfolio construction. And that's if you go back to the slides which show an extremely stable capital structure and and return. Yeah, sort of back a couple more. Yeah, that one. So if you go one or this one, yep. Does LaTrobe model the impact on the overall portfolio risk, overall portfolio volatility, by incorporating this type of product into a typical balanced or I guess for this type of investor more likely growth, a conservative client?
Thank you, Toby. Look, great question. What we typically do is present this to our advisors, and of course, they run the process of integrating that into their portfolios. But what we offer as an alternative to, as a high-yielding fixed income alternative, is just that, a 5.7% return with, you can see the volatility on screen right now, or the lack thereof. It's just a remarkably stable income play there for investors to consider. So I haven't got a formal modelling process in place at all, but just I suspect that the listeners right now can consider and can see the what this would do for a portfolio by putting a heightened allocation towards us from other lower yielding areas, such as it might be cash or even more volatile assets within portfolios that are also yielding around that. There's quite a number of alternatives to within fixed income that can return, high fives, low sixes, that kind of thing. But what they're not doing is demonstrating this kind of consistency over time.
Okay, look, thanks very much. And perhaps one of the issues which we'll be looking at in the Portfolio Management Conference on August the 6th is exactly risk measurement and risk management in portfolios. So I'm looking forward to that. Now, there's another question here. Is there a PDS? Yes, I think you mentioned that there
Absolutely, yes. PDS we can send you. It's on our website, of course, as well. So it's nice and easy to locate.
All right. Look, so Michael, thank you very much for your time. Unless there are any further questions, I'll call it quits. So thank you, and we'll look forward to seeing you all again for our next webinar on August the 13th. Thanks very much.
Thank you, Toby. Thank you all.